Map the financial lifespans of three individuals, earning identical salaries over 20 years. We expect similar paths, but 2 decades later, those starting coordinates result in three completely distinct realities. One perpetually stressed about debt, the second feeling stuck, and the third accumulating self-sustaining wealth. It is deeply tempting to look at that third person and assume they simply secured a higher income along the way. But high earners routinely spend their way into financial panic, and modest earners regularly build significant net worth. The deciding factor is what happens to a dollar after it arrives in your hands. These divergent paths are the result of three specific choices made with every incoming dollar: their immediate spending, long-term saving, or strategic investment. Over 20 years, the cumulative weight of those three verbs, spend, save, invest, determines whether a person stays stuck or builds lasting wealth. Most financial guidance fails because it isolates these actions. Telling someone to just save more treats saving as a final destination, completely ignoring how a dollar must transition through a specific sequence of steps to actually build wealth. To see why well-meaning advice stalls out, we have to look closely at the math of the first two tiers. The first tier is a mathematical dead end. For someone living paycheck to paycheck, every incoming dollar is immediately converted into an outgoing dollar to cover basic survival. When your entire income is consumed by immediate obligations, saving money is not a matter of discipline. There is genuinely zero capital left to redirect. But there is a disguised version of this exact mechanism that triggers at much higher tax brackets: lifestyle inflation. This chart shows the mechanical reality of lifestyle inflation. As the income line rises over a career, the spending line rises right alongside it, dollar for dollar. A person earning triple their previous salary can arrive at the end of the month with a balance of zero, simply because their discretionary expenses expanded to match their new take-home pay. Often, that spending is disguised as responsible progress: a depreciating luxury car bought to project professional success, or a series of expensive degrees that never yield higher pay. These purchases feel like investments in the moment, but they function purely as consumption, quietly eating the exact dollars needed to build a financial foundation. Without engineering a gap between what comes in and what goes out, progress is structurally impossible. It doesn't matter if a salary reaches 6 or 7 figures. A $0 gap guarantees a $0 net worth. Someone who manages to build that gap, deliberately protecting their leftover income instead of spending it, enters the middle-class tier of saving. By doing this, they've cleared the primary barrier that stops most people. They've successfully decoupled their spending from their earning. But keeping that money permanently sidelined introduces a quiet, continuous tax on that capital. Every year, inflation slowly erodes the actual buying power of cash. This split view illustrates exactly how that erosion works. The number on the top, the bank statement, stays perfectly stable over a 20-year period, but the bottom line tracks what those dollars can actually buy in the real economy. Over 2 decades, the cash loses a significant portion of its utility, even though the bank balance never registers a single dollar of loss. The penalty compounds when we look at the opportunity cost. Every dollar sitting in a low-yield account is a dollar not participating in the historical growth of businesses, real estate, and the broader market. Safety has a price, and it is paid with the exponential growth those dollars could have generated. A bank balance that never drops provides a recurring sense of safety. The brain interprets that non-decreasing number as total financial security, regardless of what's happening to the value of the currency itself. Because it feels like a victory, people stop there. But treating a standard savings account as a final destination guarantees a slow, invisible loss of actual wealth across a lifetime. The third tier focuses on investing as the primary engine for wealth. Here, capital is treated as a tool to be deployed into the market to capture growth and compound over time. To reach this tier, we have to completely reframe the concept of saving. A savings account is a temporary holding state. It is the staging area where you accumulate enough capital to make your next move, not the finish line. Once you have protected a gap between your income and your expenses, those dollars must be deployed into growth assets. Ownership of equities, broad index funds, or real estate is the only mathematical shield against the constant erosion of inflation. You need mechanical momentum to outpace the unseen decay of the economy. Compounding returns function like an engine, where the money you invest generates its own returns, and those returns generate even more capital, accelerating over decades. This active deployment is the exact opposite of the stagnant patterns that hold back the first two tiers. It replaces the endless consumption of paycheck-to-paycheck living, and it abandons the illusion of safety found in a decaying bank balance. Ultimately, lasting wealth has very little to do with the total number of dollars you manage to earn or hoard. Financial success is measured almost entirely by the proportion of those dollars you deliberately put to work. Achieving true financial freedom often feels like an exhaustive exercise in acquiring more money or memorizing complex financial formulas. On paper, this progression follows a predictable sequence. Models assume a clean evolution from spender to saver and finally to investor. In practice, nobody moves in a straight line. These transitions function as tangled barriers where progress frequently stalls. These stalls rarely result from a lack of mathematical knowledge. They are driven by specific psychological friction points that exist at the borders of each tier. Identifying these cognitive roadblocks is a necessary prerequisite for financial advice to become effective. The first border crossing involves moving from spending into saving. This requires maintaining a consistent gap between what you earn and what you consume. A wiring flaw known as present bias makes this difficult. It forces the human brain to heavily overvalue present comfort while deeply discounting benefits that won't arrive for decades. Relying on daily willpower at the moment of purchase usually fails because the immediate reward of spending consistently outweighs the abstract idea of future security. Automation bypasses this bias. Moving a portion of a paycheck into a separate account before it enters your daily spending pool removes the need for active decision-making. Many find the capital for this automated gap by auditing expenses driven by social comparison rather than personal utility. A low willpower system creates a more reliable savings gap than a month of active discipline. Building a savings habit reveals the next transition point. Many people build a significant cash reserve, but hesitate to move those funds into the market. A savings account balance feels controllable because it stays still. By contrast, the short-term fluctuations of an investment account create an emotional discomfort that many interpret as a signal to avoid the risk entirely. This static balance hides a different kind of risk. As the cost of living climbs, the purchasing power of idle cash slowly and predictably decays. Investing replaces that decaying cash with ownership. Productive assets, like shares of a business or real estate, generate new value that has historically outpaced the rate of inflation. This ownership allows compounding to function. When growth builds upon previous growth over long periods, the production of wealth follows an accelerating curve. Much of the fear surrounding this stage stems from confusing the long-term ownership of these assets with speculating on short-term price movements. Short-term volatility is the price for avoiding the guaranteed long-term loss of purchasing power. Even with a functional savings gap and a grasp of the math, a third, less obvious friction point often prevents action. This is an identity-based hurdle. It's the quiet belief that investing is reserved for a specific class of people with more education or specialized knowledge. This belief manifests as a persistent hesitation, causing people to wait for a level of certainty or insider status that rarely arrives. Recognizing this as a self-limiting story provides an unlock that financial data alone cannot offer. Financial success depends on engineering specific bypasses around these psychological flaws. This involves addressing the habit of waiting to accumulate a specific large sum of money before starting to invest. Fractional ownership allows anyone to start with small amounts. Modern platforms have removed the requirement for a large initial balance, making the first contribution a matter of psychology rather than capital. Building wealth requires an automated system to create a gap and the emotional temperament to hold assets through market cycles. True wealth generation occurs when you recognize these internal stories, step out of your own way, and allow time and compounding to perform the actual work.
First, think about this paradox for a second. Why does the middle class slowly lose ground to inflation? I mean, you work hard, you spend way less than you earn, you successfully create a gap between your income and your expenses, and yet somehow you still feel like you're falling behind. Well, today we're going to see exactly why just maintaining that gap between what you make and what you spend simply isn't enough if your capital is just sitting perfectly still.
All right, let's jump right into our first major concept, the 3 tiers of wealth. Those are spend, save, and invest. It turns out your long-term financial outcomes are determined by these 3 active verbs way more than your starting salary.
Okay, let's dive into this and really break down how our financial habits dictate these long-term realities. Look at column 1, tier 1, the spend tier. Here, there's absolutely zero gap between what comes in and what goes out. That's exactly why people stuck in this tier stay poor. There's literally no foundation to build on. Then we move over to tier 2, the save tier. Now, this is the classic hallmark of the middle class. They've done the hard work of building a gap between income and expenses, but they leave that gap sitting completely still. The tragic result? That money slowly but surely loses its purchasing power to inflation. And then finally, we have tier 3, the invest tier. The wealthy don't get wealthier by magic. They literally just take that exact same gap from tier 2 and they put it to work. They just step back and let compounding do decades of quiet, patient labor on their behalf.
So how do we actually bridge that gap? Let's move on to overcoming the hurdle and figuring out how to move from tier 2 to tier 3.
Now, if you're an investing beginner, trying to treat all of your saved money exactly the same way is pretty much the #1 thing keeping you stuck. If you've already built a great saving habit and your money is genuinely accumulating, your new goal is actually super specific. You just need to build enough understanding to shrink the fear that's causing you to hesitate. And a really brilliant way to do this is to separate your savings into 2 distinct psychological buckets. On the left, we've got your near-term needs, your emergency fund, money for a down payment next year, that sort of thing. That money absolutely belongs in a safe, stable account where it won't get hit by short-term market swings. But then, look over at the right side, your long-term money. If you have capital that you won't need for 5, 10, or 20 years, and it's just sitting in that same basic savings account purely out of habit, well, it's just not doing the job it could be doing.
Once you've mentally separated those 2 buckets, the path forward is actually incredibly straightforward. Step 1, you secure those near-term funds so you feel completely safe and protected. Step 2, you redirect that long-term money. And step 3, this is absolutely crucial. You start small. The absolute fastest way to shrink your fear of the stock market is to start small with real money rather than just endlessly researching on the internet. Watching a modest, genuinely invested amount go through a few months of totally normal market ups and downs, that builds comfort way faster than reading about volatility ever could. Because honestly, the fear of investing is really just a fear of the unknown. By getting some first-hand experience, even on a tiny scale, you take that scary unknown and convert it into something wonderfully familiar.
And this brilliantly illustrates what is arguably the best tool for the job, index funds. These are broad, highly diversified investments that hold tiny pieces of hundreds of different companies all at once. It means you don't have to make these highly concentrated, nail-biting bets on just 1 or 2 individual stocks.
So why does utilizing index funds work so incredibly well for beginners? First off, they're specifically designed to reduce that exact single company risk that makes investing feel so terrifying when you're first starting out. If one company struggles, it's not the end of the world because you own hundreds of others. At the same time, they effortlessly capture the overall long-term growth of the market, which is exactly what makes Tier 3 so different from Tier 2. But honestly, the absolute best part? Making this transition doesn't mean you have to abandon the incredible financial habits that got you here in the first place. That discipline of consistently setting money aside is just as valuable in Tier 3 as it was in Tier 2. You're not changing who you are literally just changing where that consistently saved money goes once your near-term needs are totally covered.
Let's shift gears and look at why making this shift is so wildly urgent. This is the compounding gap, and it shows why time is actually doing the heavy lifting.
Now, what's really interesting about this slide is just how dramatic the difference becomes over a few decades. The gap between saving and investing isn't small, and it is definitely not a straight line. Look at the spender, essentially zero accumulation no matter how much time passes. Then you look at the saver. They do accumulate a meaningful chunk of cash, but it grows in a very straight, flat line that pretty much just matches exactly what they deposited. But the investor, they don't just keep what they set aside, they stack decades of compounding growth right on top of it, creating this massive exponential curve that totally blows the other 2 out of the water.
And that explosive growth leads us to this fascinating, kind of mind-blowing reality. Time, in the compounding equation, is actually doing way more work than the physical dollar amount of your contribution. This is exactly why simply starting the shift toward Tier 3 matters so much more than how much cash you actually start with. To put that into perspective, someone who starts investing a really tiny, modest amount in their 20s almost always ends up with significantly more wealth than someone who starts investing massive chunks of cash decades later. Why? Simply because the earlier money has had a longer runway to compound and multiply.
So the crucial point is this: that compounding gap works in the opposite direction too. Every single year you spend just sitting in Tier 1 or Tier 2 instead of making the jump to Tier 3. That's not just a neutral delay. That is literally 1 year of potential exponential growth permanently lost. And the reality is, that specific year's growth can never be completely recovered, even if you try to furiously catch up by investing aggressively later on. Now, I'm absolutely not telling you this to make you feel guilty about the years you might have already spent in an earlier tier. I'm telling you this to make it crystal clear. While the absolute best, most valuable moment to begin this transition is always right now, today, no matter how much time has already gone by.
Which brings us beautifully to our final big takeaway: habits over identities, and figuring out your next financial step.
Let's move to and see how this builds into an incredibly empowering realization about our money. Quote, none of these 3 tiers are permanent identities. They're simply where a set of habits currently has you positioned. Think about that. If you're in the spender or saver tier right now, that is absolutely not a fixed ceiling on your future. It's just a snapshot of the habits you've been using up until today. And the best part about habits, they can be changed immediately, starting right now, regardless of your current income or how long you felt stuck in a rut. Thank you so much for joining me for this explainer. Ultimately, the power to transition from just saving money to true long-term wealth building is completely in your hands. So I want to leave you with this one powerful question to chew on today. Which single specific action moves you one step closer to the next tier this week? And are you willing to take